You'll be delighted to hear that there's very little by way of scheduled news over the festive holiday break, but as soon as we get back in the new year, there'll be no slacking. On the macro side, keep an eye open for the latest monthly industrial confidence surveys, these Purchasing Managers' Indices or PMIs. The UK construction and manufacturing figures are due on the 3rd of January, with services on the 4th. And also watch out for the latest US monthly non-farm payroll, unemployment and wage growth numbers on Friday the 6th. They'll all go a long way to shaping whether and how fast the US Federal Reserve moves towards the 3 interest rate hikes it's planning for 2017. On the corporate front, it's all going to be about retail for the first 2 weeks of the year as we get a deluge of Christmas trading statements. And for me, the one that could cause the biggest fuss is next on Wednesday the 4th of January. By its lofty standards, the FTSE 100 firm didn't have a great 2016. It doled out a couple of profit warnings and the shares fell from £70 to around £45 before a late rally got them back to around the £50 mark, as we can see here. November's third quarter trading statement certainly offered some encouragement and did help the shares to rally. Chief Executive Lord Simon Wolfson flagged an improvement in full price sales in October, and the company also stuck to its full-year pre-tax profit forecast. When it comes to this Christmas trading update, those are the first 2 things people are going to be looking for. Can you comment on full price sales? The trend here is going to be all important. Next has guided to a range of minus 1.75 to plus 1.25% for the whole year. Q3 was down 3.5% when retail was down 5.9% and directory was flat. Note that new space added around 1.4% to those figures, so like-for-like progress was lower still on the retail side. For full-year pre-tax profit guidance, well, the midpoint of next range is 805 million. Also watch for any guidance on 2017, though it may be a bit early for that, where the broker consensus is currently 801 million or broadly flat. The next graphic shows the last 8 years and forecasts for the next 2. This loss of momentum helps to explain why the shares did do pretty badly in 2016. Once we get past those 2 headlines of for like full price sales and pre-tax profit, 2 more issues the market will be looking at. There may be comment, there may be not. First, the dividend and next special dividend and share buyback policy. Last year's regular full dividend was £1.58p, the interim came in flat at 53. Buybacks have recommenced of late after the share price falls. An unchanged dividend would be enough for a yield of around 3% on a share price just below £50, and earnings cover will be near 3 times, assuming forecasts are met, so the dividend should be pretty safe. Second, the impact of Brexit in the weak pound. 2/3 of Next's clothing costs are in dollars, so the weakness in sterling is a nuisance, but Wolfson reckons total costs will go up by no more than 5%, owing to cost efficiencies and new areas of low-cost sourcing. The boss said Next would raise prices to cover that, the first real price hike since 2010 when cotton prices rocketed. Let's see if that's still the plan, and if so, what impact it has on sales volumes and total sales. The company's best estimate so far is a 5% price hike would maybe shave 0.5 to 1% off total revenues. Thank you for watching, and I look forward to seeing you next time.